All right, why don't we kick off? So thanks very much for coming this evening. So I guess today is going to be the last lecture on credit derivatives. You will then have, I think it's 3 more lectures on equity derivatives, and then we will end off at the end with a sort of summary lecture, kind of a revision one on the credit derivative stuff. But the next one is going to be taught by my colleague Davide. This lecture is kind of split into 2 halves. The first half is basically going to be going through a whole bunch of kind of CDS kind of contractual and documentational issues or topics, which personally I think is some of the most kind of interesting thing about the CDS contract. Kind of, in what we've spoken about so far, we've really kind of just thought of it as this instrument which has this spread and kind of goes up and down based on probabilities, based on likelihood of credit events, based on sort of the credit worthiness of companies. And now we're actually going to kind of dig into a bit of the sort of nuts and bolts about what this actual kind of contract is. This is a bilateral agreement between 2 counterparties, between a buyer and a seller, and we're actually going to kind of look at what are they actually sort of promising each other, what are the kind of key terms of this agreement. So a little bit more on the sort of legal aspects, and then in the second part we're basically going to look through some of the other credit derivative products that we trade. We're going to look through recovery swaps, we're going to look through digital CDS, we're going to look through total return swaps, which is a little bit moved away from credit derivatives, but it's still in the sort of derivative form. And then we're going to have a little look at the end at Quanto, which is essentially kind of trading CDS in different currencies. And there's some kind of interesting aspects that go on when you do stuff like that. So I think starting off on the legal side, the first thing I guess some of you might have asked yourself is what is this CDS contract that I'm actually trading? If I am buying protection, what am I actually buying? What kind of determines the credit events? How do we know whether a company has had a credit event such that there is a payment in the CDS contract? What are these obligations? What happens if a company had some debt and then decided to move that debt from A to B? How do I know that my CDS is going to kind of track that? And these were some of the things that people kind of have been dealing with for a long time. Originally, these were very much the very early CDS contracts were very much kind of bespoke, bilateral. You kind of just wrote the contract, you defined the terms as you kind of went along, and then you traded that. And then someone else came along and did a new contract, and there were potentially new terms and different terms in that one. The market has become a lot more sort of standardized over the last years, and today we are left with a contract which is very standardized and allows people to trade the many or the very large sums of notional that they're currently doing. So I guess starting off, what is a credit event? We've kind of spoken about this credit event, this sort of point at which the buyer of protection gets paid out, at which the seller of protection pays them par, at which they kind of hand over the bond. But what determines that? Who determines that? How is it determined? So I think the first thing is what is a credit event? So a credit event defined in the CDS documentation is basically kind of a bunch of headings, okay? And you can kind of choose which ones you want to apply to your particular contract. There are standard ones, so different regions trade different credit events, but the basic ones are number 1, bankruptcy. Okay, so bankruptcy is kind of like the first thing, all right, and that basically means that the company is declared bankrupt. goes into bankruptcy, files for bankruptcy protection, has a sort of secured creditor in the form of a court of law take control of them, but it's basically kind of a legal process or a legal construct that a company goes into bankruptcy. At that point, there is a CDS trigger. So CDS at that point decides, okay, we've had the event that we're looking for, and now there's going to be this payment from the buyer to the seller. When Freddie and Fannie in the US, the government agencies back in 2009 went into what they called in the US receivership, was essentially the state taking over. That was considered a form of bankruptcy, so that kind of triggered a CDS contract. Bankruptcy doesn't mean that you may have learnt in some of your sort of finance lectures around how companies are bankrupt if their liabilities exceed their assets. Okay, it's quite typical form of bankruptcy, but it's not like a state of the world. It's very difficult to know what are the assets valued at, what are the actual liabilities. So whilst it's kind of a simple way, your liabilities exceed your assets, you've got no money, you're bankrupt. For our purposes over here, we mean like the specific legal institution of bankruptcy or anything of that sort, and that's basically going to trigger CDS contracts. The second one, which is also relatively straightforward, is a failure to pay. That basically means the company fails to pay an obligation. So I think we've kind of mentioned this before, but obligations are kind of like bonds and loans. So if they fail to pay a dividend on an equity, that's not a CDS trigger. If they fail to pay a trade receivable, they've got some contract for pencils and they don't make the payment on those pencils, that's also not a CDS trigger, because what we're kind of looking for is what we call borrowed money. So failure to pay of borrowed money is a CDS trigger. Now typically in a bond you have what we would call a grace period. Okay, so that means that I don't pay you the coupon, 6%, whatever it is. Typically there's kind of like a 30-day period whereby I have to pay you, in that 30 days I have to pay you the money. If I don't pay you the money at the end of that period, then you can basically kind of start bankruptcy proceedings against me. All of your debt gets accelerated, etc., etc. But for CDS purposes, what we are looking for when we have a failure to pay is not just the company not making the payment, but actually the end of the grace period. So typically, in most bonds, you have a grace period. So when you buy CDS protection, you do need to ensure that your CDS protection covers not just the kind of payment date itself, but any potential extension that the company might have in the bond documentation because of the grace period. So typically for coupons, it's about a month. Often, not all the time, for maturities it can get up to kind of 7 days. So if you have a bond maturing on the 20th of March and you have CDS protection up till the 20th of March and they don't make that payment on the 20th of March but they have a grace period, your CDS can expire worthless if you haven't kind of covered that full extension period over there. Restructuring. So we've got bankruptcy, we've got failure to pay, we've got restructuring. Restructuring, again, companies restructure their debt all the time. They kind of go to bondholders, they say, will you change this, that, and the other? They're kind of restructuring the company, they're selling stuff off, they're buying things in. So for CDS purposes, again, it's a very kind of legal understanding of what a restructuring is. So for CDS purposes, restructuring is basically one of kind of 5 things. We'll kind of look at this in a little bit more, but basically we're kind of talking about sort of money term changes. So when they change the date that they're meant to pay you by, that would be a restructuring. When they change the amount that they're meant to pay you by, that's a restructuring. If they change one of the kind of covenants in the documentation, that wouldn't be considered a restructuring. And also the other thing about restructuring, as we'll see, is it needs to kind of be binding on everyone. So if someone opts for a restructuring, but that's just their choice, we don't actually have CDS triggering on the back of that because we say it needs to be kind of binding on everyone. And again, we'll kind of look at that in a little bit more detail. In the US, for those looking at kind of US CDS, they don't trade with restructuring. So restructuring is not a credit event for US CDS. It is for European. Why? Because European companies tend to restructure. In the US, they tend to go into Chapter 11. Chapter 11 is a form of bankruptcy, so CDS kind of triggers already, and under Chapter 11 you basically kind of reorganize things, restructure stuff anyway, so they've kind of taken out this restructuring trigger from the US because they have Chapter 11. In Europe, the various countries, although we're kind of moving towards a Chapter 11 type of construct for Europe, we don't quite have it at the moment. The next one is governmental intervention. So governmental intervention was actually something that was introduced 2014, and basically is about kind of the government changing the terms of an obligation. So rather than having a restructuring which is kind of determined by the bondholders, the government basically imposes some change on the bonds themselves. And again, we'll kind of look at that in a little bit more. It's typically applicable to European financials. And then sovereigns, when we talk about sovereign CDS, we have failure to pay. The sovereign doesn't pay you. We have restructuring. The sovereign restructures its debt, but we don't have bankruptcy because a country cannot be put into bankruptcy. There is no bankruptcy for sovereigns. What we tend to have is something else, which is kind of called repudiation moratorium, which is essentially to say the sovereign comes along and says, that debt that I owed you, not my problem. Okay? I don't owe you that money anymore. That was the previous government. That was someone else's issue. I'm not paying any of that. So that's kind of repudiation. The government basically repudiates the debt. They say that's not ours, or they declare a moratorium. They say we're just not paying that anymore. That would be a CDS trigger as well. So obligations. What are obligations? As I mentioned before, CDS only triggers when we have a event on an obligation. So for CDS purposes, we only worry about obligations, and obligations again are borrowed money. So deposits, loans, bonds, trade receivables are not borrowed money because the company hasn't kind of borrowed anything at that point in time. We can restrict the pool of obligations, so we can have a CDS contract where we basically say we're only going to have one particular obligation, or we can kind of expand the list of obligations and say, look, this equity, or preferred bond, let's say, which is really an equity, doesn't really suit us, but we'll kind of consider it to be an obligation for the purposes of our CDS contract. So we can kind of make them as flexible as we want them to be. So we have this kind of big pool of obligations, which is borrowed money, which is the company borrowing money, and then we have a kind of smaller pool, which is what we call deliverable obligations. Okay? Deliverable obligations are a subset, and deliverable obligations are basically what are the bonds or loans that you can deliver into the CDS contract when you have a credit event. Okay, so a company doesn't pay on an obligation. What can I deliver to my counterparty? And again, that's kind of a restricted pool, and the way that the contracts typically work, for example, is that we restrict it to only specified currencies. So if you have a company that fails to pay on a Thai baht bond, that would be a trigger because it's borrowed money, it's Thai baht. But for deliverable obligations, we say only euro, dollar, yen, sterling, Canadian dollar are kind of deliverables. So you can't really deliver that Thai baht bond into the CDS contract, even though it's triggered the contract. If you're trading Australian, Aussie dollar CDS, so if you're trading on Australian corporates, there's actually kind of an additional thing to say, well, although standard CDS doesn't allow Aussie dollar bonds to be delivered, because we're trading companies that basically primarily issue Aussie dollar bonds, we will allow those to be deliverable into the CDS contract as well. So you kind of have additional deliverable characteristics. Another deliverable characteristic could be, for example, subordination. So if you have a senior bond and a subordinated bond, the CDS contract typically will say that sort of a subordinated bond is not deliverable into the CDS contract. So although you might be able to have credit events on a subordinated bond, you can't actually kind of deliver it. So you're kind of looking at deliverables. So your 1 minus recovery, your R in that equation is basically based on kind of an unsubordinated bond most of the time. Succession events. Well, the succession events basically talk about when bonds move around. So if you have bonds at company A and they move those bonds to company B, then we want to make sure that the CDS kind of travels with the bonds from A to B. Okay, so it's kind of, you have a succession event. Okay, but then you have the question: what happens if they don't move all of the bonds? Okay, what happens if they only move 20% of the bonds? Should CDS go from A to B? You say no, it should probably stay. But what happens if they start to move something like 30% of the bonds? What happens if they move 40% of the bonds? So what do you do? So we have succession rules which basically determine how bonds or how CDS contracts follow bonds when they move. The typical kind of rule is basically that if you get above 75% of the bonds moving from A to B, the CDS travels with the bonds. Okay? So the CDS goes from A to B if more than 75% move. If you get less than 25% of bonds moving, so if you only get, say, 15 or 20% of bonds moving, then everything stays on company A. If you get somewhere between, so you get more than 25 but less than 75, then your CDS contract basically splits, and it will actually just split 50-50. So even if you get 26% of bonds moving, the CDS contract itself just splits 50-50, so 50% on A, 50% on B. And again, some of the reasons why we see kind of bond CDS basis occurring is because this is one of the scenarios where your bonds can go from A to B, but your CDS might split 50-50 between A and B. So the splitting is always basically just kind of proportional to the number of companies that are successors. So if a company moves 30% to A, 30% to B, and 40% to C, then you're each going to have 33% on each of those three companies. So that's basically how succession events work. But succession is all about kind of like how does CDS track bonds when they move around, and how do we ensure that that is a fair thing. The effective I suppose on succession event was interesting recently. We had a Spanish bank, Novo Bank, where they were going through various kind of iterations of restructuring of bonds moving around. They basically moved all of their senior bonds from BES, Banco Espirito Santo, to Novo Banco, and then subsequent to that, about 6 months later, they kind of like picked out two bonds, and they said, so your CDS kind of went from BES to Novo, and then subsequent to that, they basically picked out two bonds and said, those two bonds, which are, we believe, held by international investors, are going back to BES. So you had kind of two individual bonds which went back to BES. Those bonds basically recovered at like zero because BES was effectively bankrupt. Novo Banco, which was the good bank, survived. But the CDS, although it tracked from BES to Novo in the first case, didn't actually kind of track those CDS, those bonds going back to the bad bank. So you had a bit of a kind of scenario there where people, again, who had kind of bonds and CDS didn't necessarily realize their expected payoff from the CDS because the succession event that was determined in the CDS language didn't quite kind of protect them over there. So I think these are just kind of scenarios to think about, that when you do have bonds and CDS, and you think you've got like this basis package that's perfect, the two contracts are different, so you can sometimes get different outcomes. What they did was basically illegal, so it kind of screwed things up a little bit, but they managed to get away with it because they did. Effective date. Effective date on a CDS contract is an interesting concept. So effectively, essentially, when we started trading CDS, if I bought protection from you, and then I went and bought protection 3 days later from someone else, those two contracts are slightly different. Why are they slightly different? Because when I buy protection from A, my CDS contract starts at that point in time. Okay. When I buy protection from B 3 days later, my CDS contract starts at that point in time. Okay. Now, if there is a credit event in between those two dates, you can basically have one CDS contract with A that triggers and one CDS contract with B that doesn't trigger. Why? Because when I bought protection from B, it was kind of after the event had happened. Now, you might say, well, like, surely you'd know if the credit event had happened by the time you bought protection, but actually you do sometimes get scenarios where you don't actually have enough public information to tell you that a credit event has happened at the time that it happened. So you only kind of know a few days later. So there was a company back in 2009, Thomson's, which was an electronic company, French electrics company, and basically they had a loan, which was a private loan, which they didn't pay. Okay, but because the loan was private, no one in the market really knew whether they did or didn't pay that loan other than the counterparty who was on the other side of that loan. So you kind of had this scenario where if you bought protection prior to them not paying on that loan, you would be covered. If you bought protection a week later, you would think, hey, like I've got a long protection, I'm short protection, I'm basically flat. But actually, those two contracts didn't quite, match up with each other. So what the market decided to do in order to kind of stop these sort of offsetting events is basically we introduced the concept of an effective date. So the effective date is kind of like a tail. Okay, so think of it as a tail which sort of moves with you or moves with your CDS contract as you move forward in time. So effectively the tail looks back 60 days. Okay, so if you buy protection today, you have CDS protection actually starting not from today but from 60 days ago. Okay, so if there is a credit event or there has been a credit event in the last 60 days, you actually capture that in your CDS contract. As you move through time, that tail follows you and starts to kind of come, also moves forward in time and always looks back 60 days from today. So when I buy CDS protection today and then 5 days later I sell CDS protection, those two CDS contracts have the same tail, they have the same look back period, and therefore they basically kind of offset each other. Now, most of the time, like a 60-day look-back period is kind of excessive for credit events, but the main reason why we have this look-back is actually for sort of succession events. So often you get succession events, i.e. a company moves bonds from A to B. Like when a company has a credit event, it's usually quite public, so everyone kind of knows about it. When you have a succession event, it can sometimes just be like bonds moving about. They don't sort of tell anyone until the next annual report or until the next quarterly report. So in order to kind of capture succession events in the CDS contract, we have this kind of 90-day look-back period. So you kind of buy protection today, you're actually exposed to any succession events over the previous 90 days, and you're exposed to any credit events over the previous 60 days. Now, obviously, when you buy protection, all of that stuff is kind of priced into the contracts as they trade at that point. But effectively, think of the succession event and the effective date, as I said, as kind of like a tail which sort of drags along with you 60 days in the past from wherever you are at any point in time. So we've got this kind of like market back in 2004, 2005. Which had grown quite significantly, and every time there was a credit event or a succession event, you basically had to like send a fax. I mean, this was kind of pre-email as well, so you kind of had to like send a fax to your counterparty saying, hey, a credit event has happened on this company, and they had to sort of acknowledge it. It was getting a bit sort of inefficient. So what the market basically decided was that we would have a determinations committee. Okay, so there is something today called the ISDA Determinations Committee, and essentially the ISDA Determinations Committee kind of officially set up in sort of 2009, basically determines how the contracts operate for everyone. So if you sign up to trading CDS, your contract is determined by what the ISDA DC says. So you go and look at their website. Anytime there's a succession event, the ISDA DC kind of determines a succession event has happened. This is how the contract splits, and then everyone's contract splits at that point in time. They determine what the credit event, whether a credit event has happened. They determine what the deliverables are into that. It's basically a 15-member committee. There are 10 sell-side banks. There are 5 buy-side clients, and they basically kind of determine everything for the CDS market. Typically it's kind of unanimous, so as long as there's sort of a 80% supermajority, it's normally 100%, that kind of goes. If there's not 80%, let's say it's like 60-30, then it goes for an external review, and then it kind of comes back to the ISDA DC, and they make a determination based on this review. But if you are interested, you can kind of see all of the questions that have been asked to the DC, and they are up on the DC website. But basically, what the DC sort of says is final. And the other thing to kind of think about is that they're basically only making determinations for CDS contracts. Okay, what the ISDA DC says is irrelevant to everyone else in the entire world other than anyone who has a CDS contract. So there was a lot of kind of news, and we'll kind of talk about it a little bit as we go along, when Greece was having its difficulties back in 2012, defaulting or restructuring its debt, there was a lot of like news reports about whether the determinations committee would kind of say that they're bankrupt or not bankrupt, or restructuring or not restructuring. And the truth of it is that the DC is irrelevant to the world. The only relevance that they have is to people who have the CDS contract and who have basically kind of signed up to their contract. So talking a little bit about restructuring. Restructuring is a bit of it's a little bit more of a, you've got bankruptcy, company goes into bankruptcy, it's very easy. You've got failure to pay, they fail to pay, grace period passes, easy kind of trigger. Restructuring is a little bit more difficult because you've got, what does it mean to restructure? So I think the first thing to think about with restructuring is what we mean when we talk about restructuring. We talk about a change to one of the payment terms of the contract. Okay, so the payment terms are basically interest and principal. So a change to the interest, they put the interest rate down, or they change the principal. You were owed 100, now you're owed 50. That is a CDS trigger. They changed the currency, so they were basically going to pay you dollars, and now they've basically decided to pay you Zimbabwean dollars. That's a change to the contract. That's a change to one of the money terms. That is a credit event. Maturity extension. We were going to pay you in a year's time, but now we're going to pay you in 5 years' time. That is a maturity extension. And subordination. You were a senior unsecured creditor, and now you're a subordinated creditor. Again, that's kind of a change to the actual sort of money terms of your bonds. So you have a credit event on the back of that. So number one is, when we have a restructuring, it needs to be a restructuring of a money term. Okay. So if you see a change to some other term, they change some of the voting rights, or they change some of the covenants in the documentation, that doesn't trigger CDS at that point in time. The second thing is that it needs to be binding on all holders. Okay, this is a kind of key thing that worth understanding, is that when you have a CDS contract, if an exchange offer is offered out to everyone, a purely voluntary exchange, give me your bond and I will give you a new bond, that is not going to trigger CDS because it's not binding on all holders of the obligation. How does it become binding on all holders of the obligation? When you have something either where everyone is kind of voting for it, or where a court imposes it, or where you have sort of a collective action clause. Collective action clause is a term within bond documentation which basically says if more than X% vote in favor of a restructuring, shall we say, a extension of maturity, then that applies to all bondholders. So the idea is basically, we don't want to have a situation where minority bondholders are basically able to kind of hold up a restructuring that the majority of bondholders and the company are trying to get done. So in order to kind of stop the minority of bondholders doing that, we have collective action clauses. More than 75% say because 10% of the people were snoozing or on holiday or didn't know that they owned the bond, or who knows where they were. You don't want to kind of hold up the restructuring, so you have these collective action clauses. That makes it binding on everyone, and then it kind of goes on from there, and then that's a CDS trigger event. Interestingly, in the US, I believe it's the 1930s Financing Act or something, or Companies Act, basically says you cannot have restructuring. You cannot have collective action clauses in bond documentation. So in US corporates, you actually don't have collective action clauses because the US, being the US, basically decided that if you have collective action clauses, you're basically overriding minority rights. And therefore you're not allowed to override minority rights, so you basically can't have a collective action clause. You cannot have the majority kind of imposing a deal on the minority. Interestingly, they basically ruled that only applies to corporates. Emerging market or sovereign debt written under New York law, interestingly, does have collective action clauses because they decided that this kind of ruling wasn't applicable to sovereigns. And then finally, the kind of third thing. So when we're having a restructuring credit event, we look at is it a change to the money term? Is it binding on all holders? And number three, is there credit deterioration? So what I mean by that is if the company's like doing very well, goes to its bondholders, says, we're doing quite well, we're going to either call this bond or we're just going to kind of put down the interest rate from 5% to 2%. If all of the bondholders agree to that, then it's not a credit event because essentially the company's like doing well. So we kind of need what we call credit deterioration. It's not a very high bar, but we need to sort of show that there has been a deterioration in the credit in order for you to have this credit event. So, and then some of the stuff that kind of brings this all together is thinking back to Greece in 2011, 2012. So Greece got into difficulty, needed to restructure its debt, went to bondholders and said, I've got a new deal for you, give me your old bonds, and I will give you a new bond. You can have an option of 4 different things. One of them had a slightly lower coupon, one of them had a slightly longer maturity, one of them had a slight sort of haircut. There were a whole bunch of a kind of smorgasbord of options that you could kind of choose. Now that wouldn't have been a credit event if it had gone through. Why would it not have been a credit event? Because it was optional. They kind of went to bondholders and said, if you want to help us out, give us your bond and we will give you a new bond. Okay? So we'll kind of restructure you into a new bond. We'll change the terms of your bond, a money term, but it's not, it basically would fail the kind of binding on all holders bit. Okay? So it was voluntary. One thing I should say is, a company cannot just change your bond. Okay, so if you have a bond that says I'm going to pay you, par at maturity plus 5%, the company can't just come to you and say, well, I decided I'm not going to pay you 5%. I'm only going to pay you 2%. Like you have an agreement there. The bondholders have to agree to it. So the bondholders have to vote for something, but it still needs to be kind of binding on all holders for CDS. For CDS purposes. So Greece kind of came and did this sort of exchange offer in 2011. It was basically kind of rejected. Now the reason why they did an exchange offer is they didn't have collective action clauses in their bonds. Okay, so they couldn't do something that basically involved everyone, and they were basically worried that if they kind of there was just no way to bind everyone in this unless they got 100% of people agreeing to the terms. Okay, so what did Greece do? Something like 90% of Greek debt was issued under domestic law. Greek bonds issued under Greek domestic law. So what did they do? They basically passed a law in Parliament. They passed an act of Parliament that said all Greek law bonds now have collective action clauses in them. Okay? So they retroactively fitted collective action clauses into all of the Greek bonds. Okay? That was not a credit event because they hadn't changed any of the money terms. Okay, you know what's going to happen next, but at that point in time, you haven't actually had a credit event. So now they have all of these collective action clauses in the bonds. The international law bonds already had collective action clauses in them, but now they basically had them in the domestic law bonds. They then offered an exchange offer. They had all of the kind of Greek banks, Greek insurance companies, Greek pension funds kind of lined up to sort of tick the box and say yes. They then had more than 75%. I think the eventual threshold got down to like 60% or whatever it might be. So now these bonds have collective action clauses in them. They introduce a restructuring. It gets the 65, whatever, 70% acceptance rate, and then everyone kind of gets swept along. So at that point, you actually get your CDS credit event, you get your restructuring event, and then you have a new kind of obligation at the end of it. So, if you were kind of watching what was going on in Greece from the sidelines, it might have all looked a little bit confusing. They've offered a restructuring. Why are they not in default? Why hasn't CDS triggered? At least hopefully now you can kind of understand a little bit more about like what kind of specific events need to happen for our CDS contract to trigger on a restructuring credit event. So why is restructuring different? Some of it is because when you I think probably one of the biggest issues is that when you have a bankruptcy or a failure to pay, effectively all of the debt outstanding becomes due and payable tomorrow. Okay, so if you go into bankruptcy, whether you have a 5-year bond or a 10-year bond or a 30-year bond, they basically all become due and payable like today. Okay, if you have a failure to pay, typically what people do is that they then sort of accelerate bonds. So, I failed to pay on my bond here. The chap over there with a 10-year bond accelerates his bond, which basically means his bond is also due and payable today. So there's no real kind of restructuring there's no real maturity in a failure to pay or in a bankruptcy. With restructuring, however, you still have a maturity of the bond. So if you have a 1-year bond or a 10-year bond or a 30-year bond, there's actually kind of like a different price to all of those bonds because they have a different term, they have a different sort of maturity to each of them. So in Europe, what we have is we call MMR, which is modified restructuring, which is essentially saying that if I have 5-year CDS, I can only deliver a 5-year bond into the CDS contract on a restructuring. So I don't let the maturity go really beyond my CDS contract. Okay? If I have 10-year CDS, I can deliver a 10-year CDS contract into the contract. Now, that basically applies if the buyer of protection triggers the CDS contract. So me as a buyer, I've got 5-year CDS, I trigger my CDS contract, I can deliver anything 1, 2, 3, 4, 5, up to 5-year bonds, okay, maturity. If the seller of protection triggers, on the other hand, then all of a sudden the kind of maturity jumps to 30 years. So you can basically deliver anything up to 30 years into the CDS contract. So there's a slight kind of difference between whether a buyer of protection triggers on a restructuring or whether a seller of protection triggers. In a bankruptcy or failure to pay, because there's kind of no maturity, all CDS contracts trigger at that point and there's no kind of buyer or seller trigger. But for restructuring, there is kind of this optionality in the trigger as well. Okay, so what does that mean? It actually means you can get situations where a company restructures its debt, but neither the buyer triggers the contract nor the seller. Company restructures its debt, pulls down the coupon by 1% or whatever it might be, but the bonds are still kind of trading at like par or 95. The buyer of protection might think, well, it's not really in my interest to trigger the CDS contract because my CDS contract is worth more than that, and I think they're actually going to have another credit event in a year's time. The seller of protection at the same time might think to themselves, well, if I trigger the CDS contract, all of a sudden I'm opening myself out to 30-year deliverables into the CDS contract, so I'm also not going to kind of trigger my CDS contract at that point in time. So you do get situations essentially where neither the buyer triggers nor the seller. Typically, the company's basically not doing very well in most of those cases anyway, and you end up getting like another CDS trigger later down the road. So if you do look at kind of a historical list of credit events, often you get a restructuring trigger, but people sometimes don't kind of trigger that, and then there's a bankruptcy or a failure to pay down the road from that. Governmental intervention was introduced, so all these other things that we've kind of talked about have been introduced in 2009. Governmental intervention was introduced in 2014. What kind of prompted it was essentially, one of the things that kind of prompted it was the new BRRD, or Banking Restructuring and Resolution Directive, which effectively kind of applies across the whole of the EU. And one of the kind of key cases in this was, I think I mentioned it in one of the kind of earlier lectures, was SNS, which was a Dutch bank. Okay, what happened? There was the bank got into kind of difficulties, and on Friday evening, kind of after market hours, the Dutch government basically expropriated the subordinated bonds. Okay, so you had a bond, subordinated bond. It was eligible for CDS contracts, and the Dutch government basically over the weekend took that bond away from you. So when you went to kind of look in your bond locker and you kind of looked over there, basically there was nothing left. Okay, now as we've seen for CDS, we've kind of got a trigger over there because it can be viewed as a reduction in your principal. It was binding on everyone. So you kind of have a CDS trigger at the end of that, but the problem is that you need a deliverable. You need to actually deliver something to your counterpart. Okay, so you didn't have a bond to hand over. So what ended up happening is you had to deliver a senior bond, because if you have subordinated CDS, you can deliver anything at that level or higher. But obviously the recovery on the CDS contract was much higher than people had expected. So they kind of lost 100% on their bonds, but they maybe only made kind of 20% on their CDS. So essentially it was kind of viewed as something that wasn't kind of ideal situation. The other issue that has kind of arisen from BRRD is that typically when we have a restructuring, we basically talk about things that are kind of not allowed in the contract, right? So if the CDS, if the bond contract says, the maturity is 2025, but the company has an option to extend it by 2 years to 2027. If they exercise that option and extend the maturity of the bond, then that's not a CDS trigger, because the bond basically told you that they could do that. Okay? Or if the bond documentation says, we can reduce the coupon if X, Y, and Z happens, X, Y, and Z happens, they reduce the coupon. Again, the bond documentation told you that you could do that, so it's not a CDS trigger at that point in time. One of the issues that kind of arises today is that under BRRD, under this kind of banking resolution, basically governments can do whatever they want to banks' debt. Okay? Basically the legislation as it stands today, the regulation essentially gives governments and regulators the ability to do whatever they want. So if you thought you had a bond, you don't have a bond. If you thought you had protection here, if you thought you had some obligation rights, you don't have any of that. Okay. Now bonds are being written with this language in it, which basically says, if this company goes into resolution, you have zero rights. Your bond will be taken away from you. Okay. So it tells you when you buy the bond that your bond is going to be taken away from you, and you're going to have nothing left. So the whole idea behind having governmental intervention is basically to give CDS market participants protection against things like expropriation, to give them protection against things that, even though the bond documentation tells you that you have a bond which may be worthless, your CDS is still going to give you kind of the protection from that over that bond. So, one of the things that was introduced, as I said, more recently, because historically no one worried about these things. No one thought that governments could actually kind of expropriate property. These days, no one worries about governments expropriating property. So basically, we have this kind of GI event, which gives you an added level of protection. The other thing about GI is that it basically allows asset package settlement. So what asset package delivery means, or asset package settlement, is basically to say, if I do have this GI credit event, this governmental intervention, and I'm given equity, I'm given a ticket to a hearing in The Hague, I'm given some rights to some aluminium smelting plant, who cares what it is, which you can't deliver into a CDS contract because it's not an obligation. You can basically deliver that. You can basically run an auction, run a price discovery on whatever you get at the end of it, and that becomes the kind of recovery rate for the CDS. So when you have asset package settlement, which basically at the moment only applies, there is talk about kind of expanding it to more things, but basically only applies to financials, you can have asset package settlement and you can kind of deliver the equity, even though equity would not be an obligation. So in the case of SNS, when you had nothing in your locker, you would basically deliver the kind of ticket or the ISIN, which was essentially worth nothing, and that would go into the CDS contract. So some kind of case studies, Lehman's, kind of one of the more high-profile bankruptcies in our market back in 2008. It was at the. I think it's kind of testament to the robustness of the market that you had Lehman's, who was one of the major counterparties in the CDS contract, one of the major dealers out there, filing for Chapter 11, essentially going bankrupt, and within a month of that happening, the market kind of moved on, had a credit event, had a auction, had a recovery for Lehman's. It ended up at sort of 8.5 or so in CDS terms, and kind of everyone went on their merry way. Greece we've kind of spoken about. Again, 2011 voluntary exchange, not a CDS trigger. But 2012, when there was a credit event, you actually got a CDS trigger and a recovery of kind of 21.5 from Greek CDS. So how do we settle CDS contracts? So we kind of looked at how the contracts work, but now we kind of we've got all of these contracts, we've got a credit event. How do we determine what the R is, what the recovery rate is that kind of applies to all these CDS contracts? Because we basically want to make sure that payouts are all the same, that if I'm paying you an amount, you're paying that on to someone else, or someone else is paying me. So if we're kind of netting things out, everything is kind of equaling out. So prior to 2005, you had all of this kind of bilateral triggering, and then you would just hand over an obligation and someone would give you par in exchange. In 2005, we introduced auction settlement. We'll talk about that in a second. And then in 2009, basically auction settlement became the kind of market standard. So if you trade a CDS contract today, unless it's a sort of bespoke or alternative CDS contract, everything basically goes into what we call the CDS auction. And the CDS auction essentially works in a way that allows you to replicate physical settlement. Okay? So if you have a bond and CDS, the auction basically allows you to deliver the bond into the auction. You receive R recovery for your bond, and you receive 1 minus recovery for your CDS. So the combined bond plus CDS is basically worth par. Okay? So it allows you, the whole point of the auction is that it basically allows you to kind of replicate physical settlement. So if you do want to deliver a bond and receive par in exchange for it, you get recovery from your bond, you get 1 minus recovery from your CDS. Together you've basically handed over a bond and got par in exchange. Similarly, if you are a seller of protection and you basically want to stay long the bond, what you basically would do in that case is you would go into the auction, you would buy bonds, so you would pay recovery for your bond, you would pay 1 minus recovery on your CDS contract, and essentially you've paid par and you've received a CDS, a bond contract on the back of that. So you're basically able to replicate physical settlement. If you just want to cash settle, then you basically don't do anything with the bond, and you basically just pay or receive the 1 minus recovery. So a buyer of protection would receive 1 minus recovery, a seller of protection would pay 1 minus recovery. Auction settles at 30, person owns a bond, they sell the bond at 30, they receive 70, 1 minus 30 from the CDS contract. Net, they're basically going to be receiving 100 and paying out the bond. Similarly, if you are just a sort of naked long position, recovery is 40, your CDS contract terminates at 60, and you have no settlement from your bond contract itself. So how does this kind of auction work? How does the market kind of determine what the fair price is, what R is on any given day? So basically there's a certain day is determined as auction settlement date, and on that date it's effectively an event for everyone in the market to kind of get together and sort of settle and find the sort of recovery rate for these CDS contracts. And as I said, that recovery rate basically applies to everything. So all CDS contracts settle at that amount, and all bonds that go through the auction also settle at that amount. So stage one is kind of like a two-step process. Stage one of the auction, the dealers submit an initial mid-market. So they're basically going to kind of submit a 49.51 market, and they also submit the open interest that they have for physical settlement. Okay, so physical settlement basically means people who want to buy bonds in the CDS auction and people who want to sell bonds in the CDS auction. So all CDS is going in, but if you have an index position, for example, you probably don't care about like owning or selling bonds, you just want the cash settlement. But if you have a basis trade or you want to stay long the bond, then you have an interest in physical settlement. So each of the dealers basically kind of tots up what their net open interest for physical settlement is based on the CDS trades that they have from themselves, from their clients, and they submit that into the auction. At the same time, they kind of submit this initial mid-market, and then in stage 2 of the auction, based on essentially this mid-market and the open interest. So if the open interest is to buy bonds, then people come in the second round of the auction and they basically say, well, people want to buy bonds, so I'm willing to sell them at this level. Someone else comes in, I'm willing to sell them at this level. And we basically kind of clear the open interest, and the level that clears the open interest is the number that basically gets applied to kind of everyone. So again, looking at that in a little bit kind of more detail, you've got 8 dealers, 8H. Each one of those dealers submits like a bid ask. Okay, so we've got an auction and they're basically kind of centered around sort of 40. So market takes all of these. They then basically look at who are the best bids and who are the best offers. Okay, and they basically take the 50% of the best bids and the 50% of the kind of best markets effectively, and based on those. I should say before. The first thing that they do is they take out the sort of tradable markets. Okay, so at the top there you've got tradable markets in the sense that dealer D was bidding bonds at 45. Okay, they're willing to buy bonds at 45, and dealer E was offering bonds at 34, so they were willing to sell at 34. So you've got like a crossing market over there. One dealer's willing to buy, the other one's willing to sell, and they're like the opposite ends of where they should be. So basically what happens is that those trades get kind of crossed out, okay, because they're crossing markets. And in addition to that, the dealers who are on the wrong side will actually get fined. Okay? And they'll basically get fined an amount equal to the difference between where their mid-market, where their bid or ask was versus the mid-market. And they basically get fined if they're on the kind of the wrong side. All right? So if, for example, there's open interest to buy bonds, okay, so there's open interest to buy bonds in the auction, the dealer who is bidding 45, like that's fair enough. Like they're willing to pay more because they know that there's open interest to buy bonds, so they're willing to kind of pay for that. The guy at the one who's offering at 34 on the other hand is kind of like on the wrong side of that. So effectively they get kind of penalised because the idea is that they're kind of trying to sort of skew the model or skew the market one way or the other. So you kind of get rid of these crossing markets, you get rid of you then take the kind of best half of the next, and you calculate the sort of average of those, and that basically comes out at like 40 points, whatever. Okay, so that's your like initial mid-market. So stage 1A is finding the initial mid-market. We then tally up all of the bids and offers or the net bids and offers from the different clients. So here there's like 500 million, I think, of sell requests. There's 150 million of buy requests. So net there is 350 million of sell requests. Okay, we know what the initial mid-market is, 40.625, and now it basically comes up. So 40.65 is the initial mid-market. There's open interest to sell bonds. So now anyone in the market, people who don't have CDS, can kind of come in and buy bonds. Okay, so someone comes along and they say, I'm willing to buy 30 at 40.65, and the next guy says I'm going to buy another 40 that. Then C comes along, and you kind of go down the list until you basically find an amount which is this 38.875, such that everyone above that, if you add all of that up, you've basically made up the 350 million of open interest. Okay, so it's a process called a Dutch auction, and then basically if you bid for bonds above that level, then basically you will, as long as you kind of bid for bonds above that level, you will basically be done at whatever that sort of final settlement price is over there. If you bid for bonds below that level, then you're kind of out and you don't get traded on in that trade. So this kind of final settlement price, 38.875, is basically kind of the final mid-market, is the final number, is the final recovery that is applied to all CDS and all bonds. So anyone who wants to buy bonds gets done at that level, anyone wants to sell bonds gets done at that level, and any CDS closes out at 1 minus whatever that level is. So that's essentially how the auctions are run. You can kind of, it takes a little bit of getting your head around that kind of auction mechanism, but it typically is, it does work pretty well. The other thing I guess that we should sort of touch on in this part is, as I mentioned, we kind of touched on it a little bit earlier, it's more sort of for your information. When we, as I said before, when we have restructuring in Europe, we have a maturity limitation up till the maturity of your CDS contract. So if you have 5-year CDS, you can deliver up to 5-year bonds. If you have 4-year CDS, you can deliver up to 4-year bonds. If you have 7-year CDS, you can deliver up to 7-year bonds. Now, the issue that kind of arises is what happens if I have, 5-year CDS and 4.5-year CDS and 4-year CDS, and there are like a whole bunch of different bonds. So there's a whole bunch of like different deliverables into all of those different contracts. Very difficult to run an auction based on kind of having a uniform settlement for everyone when you've got lots of different kind of maturities out there. So essentially, because we trade like CDS every 6-month maturity, you can effectively have a new CDS auction for every 6 months. So the solution to this was basically to introduce this concept of buckets, which is basically to say that if your CDS falls into a 2.5 to 5 year bucket, then basically you're going to have deliverables up to 5 years. So even if you have 3-year CDS, you kind of get the benefit of having a deliverable up to 5 years in order to just kind of concentrate all CDS contracts into a single into a single contract. Similarly, if you have between 5 to 7.5 year, anywhere between that, you have 5 year or 5 years, 6 months, 6 year, 7 year, whatever it is, you kind of fall into that bucket, and then you can kind of deliver anything that has a lower maturity than that. I should say this is probably one of the things about CDS that confuses people, even ones who have been active in the market for a long time. So there is some talk of actually doing away with it, but not yet. That is basically us done on this section. And that is essentially, there's a few kind of resources that are listed over there, but that is basically all of the stuff on kind of legal and documentational issues. Any questions on any of that before we kind of move on? No? Super. Let's crack on, and we'll have a break in a little. All right, so as I said, the last section was a little bit more, kind of legal, theoretical, not really theoretical, but practical, more kind of documentational based. It's important when you're looking at CDS contracts, when you're kind of thinking about them, to actually kind of understand. It's important to understand all of the kind of maths about it, to understand pricing, to understand all of these things, but actually kind of when you are trading it on a day-to-day basis, or like looking at it in a bit more detail, it's very useful to actually understand like what actually is this CDS contract that I have. This part now that we're kind of moving on to is actually going to be talking about sort of other derivative products and kind of variations on some of the stuff that we have seen so far. So the first thing we are going to look at is recovery products. We'll then talk about total return swaps, and then we'll kind of talk about sort of Quanto CDS, which is a sort of fancy word for trading CDS in different currencies. So what is a fixed recovery CDS contract? Okay, so all of the CDS contracts that we've basically dealt with so far effectively pay out based on whatever the bonds recover at. Okay, so if you buy protection, if the bonds recover at 20, you get a payout of 1 minus 20, so you get a payout of 80. A fixed recovery CDS, on the other hand, is basically a CDS contract which gives you a kind of fixed recovery at inception. So we basically decide that we are going to have a CDS contract which has a recovery rate of 45. Okay, so if there is a credit event, it's going to pay you 55, 1 minus recovery, irrespective of what happens. Okay, so irrespective of where the bonds are trading at that point in time, we're basically going to kind of fix the recovery rate to be 45 or whatever we want it to be. An example of a fixed recovery CDS is a zero recovery CDS. Okay? Zero recovery CDS basically says if there is a credit event, irrespective of where the bonds are trading, I'm going to pay you 100. Okay? So whatever happens with the actual bonds themselves doesn't matter. I am always going to pay you 100 if I'm a seller of protection. So the question is, how do we kind of value these things, and how do we sort of think about the pricing of these instruments? So I guess the kind of place to sort of start off with is our CDS equation that we have at the top over there, that essentially the PV of a CDS contract is equal to the contingent leg plus the fee leg. Okay, those are kind of standard CDS contract that we have out, or pricing of effectively any CDS contract that we have out there in the market. So how do we kind of start to think about fixed recovery CDS? We basically can kind of write that out as the contingent leg is equal to 1 minus recovery multiplied by our hazard rate, or by our kind of default probability, multiplied by our risky annuity, where our risky annuity is some function of kind of the probability of default, and rates and time. Let's get rid of that for the moment. But basically, it's a function of default probabilities, time, and our discount factor. So that's our contingent leg over there, and then our fee leg is basically just going to be our spread multiplied by our risky annuity. So effectively, minus over there. But basically, the kind of value of the contract is essentially equal to the kind of difference between our fee leg and our contingent leg. Now, in a fixed recovery CDS, what do we basically do? We basically just kind of fix this guy over there. Okay? So effectively what we're going to say is we're going to kind of fix the recovery on our CDS contract. And then what we want to say is, well, what is kind of like the, what is the spread on this fixed recovery CDS contract? So we're basically going to say, for a fixed recovery CDS, what is the spread that we should pay on a par contract for this? Now, if we go back to what we've kind of seen in previous lectures, that if we can kind of rewrite our default probability as as spread spread, and this is not the fixed spread. This is our floating or our, typical CDS spread for the par contract over 1 minus R. Again, this is our kind of non-fixed recovery CDS, and we basically take this guy and plug it into our lambda over here. Okay, what are we going to get? Well, we're basically going to get that if we equate this thing to 0, so if we essentially say that the contract is kind of like at the fair level, i.e. the fee leg and the contingent leg are basically equal to each other, we're essentially going to be left, once we do a little bit of rearranging, with our fixed recovery CDS is basically going to be equal to 1 minus R fixed divided by 1 minus our floating rate recovery times by our typical par spread, essentially. So essentially what we're kind of thinking about it, and you can kind of take this over to the other side, but basically what we're kind of saying is that the kind of ratio of spreads of fixed rate CDS to floating rate CDS is essentially equal to the payout from a fixed CDS divided by the payout from a floating CDS. So effectively kind of the payout ratio is equal to the spread ratio. And kind of how do we think about that intuitively? Like if I've got one CDS contract that's paying me X, let's say X is 1 minus recovery, and I'm willing to pay S for that. If I've got something that's paying me 2 times X, how much should I pay in spread? I should pay 2 times spread. So effectively, like the ratio of payouts is basically going to determine the ratio of spread. So again, if we take an example, what have we got over there? We've said, your par spread is 200, your fixed rate running spread, your fixed rate over here is 0. So we're basically going to get our fixed recovery is equal to 100 divided by, if we assume floating is 40% recovery, so divided by 60 multiplied by a spread of 200, this is running out, is basically going to give us so 1 minus recovery fixed, which is going to be 100, divided by 1 minus recovery floating, which is 60, is essentially going to give us a spread of 333 basis points. So if the floating rate spread is 200 basis points, a fixed recovery CDS contract which has a fixed recovery of 0, i.e. pays us out 100, is basically going to have a spread of 333. So essentially a 0 recovery CDS contract is going to be more expensive obviously than a floating recovery CDS. So buyer of protection would have to pay more for that, but similarly the seller of protection would be receiving a much higher spread if they were to go through this contract. How do we kind of do that when we have upfronts in CDS contracts? So just as a kind of reminder, your upfront in your CDS contract is basically equal to, how have we done it? Spread minus coupon times your risk annuity. As we've kind of seen throughout, the upfront in the CDS contract is equal to the spread minus the coupon times risk annuity. If we basically say that this is now going to be our kind of fixed rate spread over there, that basically will then allow us to essentially calculate what is our sort of upfront in a fixed rate CDS contract. So the risk annuity over here, remember, is not based on this fixed spread, but this is effectively going to be a function of whatever our kind of par spread is whatever our kind of interest rates are and whatever our sort of time to maturity is going to be. So essentially, the risk annuity is going to move around, but basically the upfront for a fixed CDS contract is basically just going to be that. So how does that kind of combine into a recovery rate swap? So what we've kind of looked at here is sort of fixed recovery CDS, i.e. we have like a fixed payout, but we also have something which is basically a recovery swap. And what is a recovery swap? A recovery swap is essentially an instrument where the exposure that I have is basically just to recovery. So I basically want an instrument which pays me out 1 minus recovery in the event of a credit event, but essentially there's going to be like no other coupons in the interim. Okay, so we're basically going to kind of enter into a contract which is purely a recovery rate trade. Okay, so if recovery is above the fixed recovery, I'm going to make money. And if recovery is below the fixed recovery, I'm basically going to lose money. So I kind of come into a contract where I like strike my recovery. If it goes above that, I make money. If it goes below that, I lose money. So how do we kind of think about pricing of a fixed recovery CDS? Well, essentially what we're going to do is we're going to come up with a contract where the how should we say it, the coupons on the fixed rate CDS are equal to the coupons on the floating rate CDS. Okay, and the upfront in the fixed rate CDS is equal to the upfront in the floating rate CDS. So if we have something like this, so if we imagine we have a what have we done there? We've done a standard CDS contract. So standard CDS contract looks something like this. There's some payment of 1 minus recovery if there's a credit event, and then there are coupon payments from the buyer of protection to the seller of protection over the life of the contract, and those are equal to whatever the spread or the coupon that we're going to define is. And if we say that those are equal to some fixed coupon, there might be some sort of upfront that is paid out in that CDS contract as well. So this is our kind of standard CDS contract. If we then do a fixed recovery CDS, which basically looks exactly the same, pardon me, has some kind of upfront over here and has coupons which are equal to but has a fixed recovery over there, we're basically going to have all of these coupons kind of cancelling out with each other. We're going to have these two things cancelling out with each other, and essentially all that we're going to be left with is the difference between this contract, which pays 1 minus recovery on a floating basis, and this contract, which pays 1 minus recovery on a fixed basis. So the net kind of result that we have from that is basically going to be something that looks like that, and essentially is going to pay at this point in time, so we don't have any of that, our fixed minus our floating rate recovery. So essentially that's kind of going to be the sort of the payment when we combine these two contracts together. So how do we trade stuff in the market? You basically have a market for recovery. So here's OTE, which was a Spanish telecoms company, and the recovery rate market is quoted as 35.45. Okay, so if you go long recovery at 45, okay, if recovery ends up being 70, you're going to make the difference. You're going to make 25, so 70 minus 45. Okay, if you went short recovery at 35, okay, but recovery ended up being 70, then in that case you're actually going to lose the difference between 70 and 35, so you're going to lose 35. Okay, so recovery basically works that your P&L is effectively the difference between where the fixed recovery is and where the floating recovery ends up being. Okay, but the important thing is that there are no kind of like CDS coupons, and there is no upfront payment into the contract. Okay, so the only payment is at the end of the contract when you actually have a event and you have a payoff or you have a recovery rate, and then you kind of work out how that trades relative to where you fixed your contract at inception. So again, how do we sort of value these fixed rate contracts that we have over here? But basically what we're essentially going to say is that the PV of the fixed recovery CDS is equal to the kind of contingent leg 1 minus recovery times by our risky annuity, and the PV of the fixed recovery CDS is also going to be equal to lambda times 1 minus recovery fixed multiplied by our risky annuity over there. So the reason why the PV kind of gets rid of the sort of floating rate, of the fee leg, is because the fee leg in those two contracts is basically going to be exactly the same between the two of them. And then essentially we just have to kind of look at the difference between these two. So the difference between the PV of the, we do have plus some amount here, plus some amount there, but those two things are kind of going to be equal to each other as we saw earlier. So basically the PV of this contract, which is the difference in a fixed recovery CDS and a floating recovery CDS, the contract value, let's call it CV, for contract value is basically going to be equal to, if we take our lambda here times risky annuity multiplied by recovery fixed minus the standard recovery floating. Okay? So essentially what we are left with is a contract whose value is equal to the difference between the fixed recovery and where the market implied recovery is, multiplied by the probability of effectively getting that recovery at some time in the contract. So if you have recovery, as we saw over here on the previous page, if we have recovery at, let's call that a mid of 40, and let's say let's ignore the bid ask for the moment. Let's just say you kind of went long recovery at 40, and the market then starts to imply recovery at 50. You might not actually have made any money, because if your probabilities don't actually change as well, you might not actually be able to kind of realize that actual recovery, right? So you actually have not just a change in the recovery rate, but the actual probability of realizing that. So as the probability or the likelihood of default starts to go up, you actually start to kind of make more money from, or you actually start to realize this until this thing basically kind of goes to 1, in which case this thing goes down to 1 as well, and then you basically make your recovery rate differential from your CDS contract. So as a kind of example, we sell OTA protection, as we saw on the previous slide, at 35. So our fixed recovery is going to be 35%. What have we said then? We've said 1 month later, market expectation of recovery goes down to 30. The spread is 500 basis points, and we'll just assume a risky annuity of, so spread is equal to 500. We're assuming a risky annuity, might not be exact, of 4. So how do we then kind of calculate our P&L, which is over here? We're basically going to say, well, lambda we know is spread over 1 minus recovery. So 500 divided by 1 minus 20, because 20 is the market implied recovery at that point in time. So that basically gives us our probability of default times our risky annuity of 4 multiplied by 35 minus 20. 35 was where we struck our recovery. 20 is the current level of recovery. And that basically, as you can see over here, gives us a P&L of 3.75. Right? So even though recovery went from 35 down to 20, so even though there was a 15-point change in recovery, the P&L on our contract was only 3.75%, because not only do we need to take into account the change in the recovery, but we also need to take into account the likelihood of actually realizing that recovery. And how do we take into account the likelihood of recovery? We basically look at our contingent leg, which is essentially our probability of default multiplied by the kind of time to getting that default. So again, recovery rates are kind of nice. They mean that there's no outlay. You can take a view on where the market is implying recovery, which tends to be 40%, versus where you actually think that the ultimate recovery will end up, in our case over here, 20%. But they are kind of an additional tool which kind of is out there and allows you to sort of trade CDS or to trade a form of CDS contracts. If you look historically at how recoveries have kind of traded in the market, we've kind of tended to have we have this assumption of like 40% recovery, like most CDS trades at 40% recovery. I guess the interesting thing is that on average recovery is actually around kind of 40%. You had a whole bunch of banks, Hellas Telecom, Truvo, Sayat, the yellow pages over there, which were all recovered kind of very low, and then you had a whole bunch of banks. You can see sort of SNS at the top over there, which we spoke about, Bankia, Thompson's, which kind of came out at 70. Interesting, again, you've got Thompson's 1, which is the black one, and then you've got Thompson's 2, which is the blue diamond. Again, as I mentioned, there was kind of a restructuring and then subsequently a bankruptcy of the whole entity. But on average, kind of recovery tends to be 40%, but there's obviously quite a big variability in where recovery actually ends up trading. So if you want to try and take advantage of that, one way to do it is through fixed recovery CDS, which basically allow you to do that. Why don't we have a break for 15 minutes? So if we get back at 1:45, and we will go on. Hello.
So we saw on slide there was a recovery of 8.something% for Lima.
Yeah.
And so basically that means that we're people that were willing to buy demand bonds, right?
Those are where the bonds were trading in the market at the date when the auction happened.
Okay,
So they were still, even though the company had gone bankrupt, the bonds were still transacting.
who buy bonds and what rationale?
Some of those bonds recovered at par
Okay. How did that happen?
because they went through restructuring and they were creditors. They got paid.
So it does make sense for an investor to actually buy.
Yeah, they might be worth nothing. I mean, the market's implying that they're worth 9. But, or maybe you buy them at 9 and they go up to 20 and you sell them for 20. So, because effectively what you're buying is you're buying the right to kind of go through litigation, realise your kind of eventual recovery.
What happens?
I mean, basically, bondholders get paid out, and so liquidation. I mean, it's rare that often companies will restructure, but you could get a situation where they sell everything out, and then you're kind of left with what Hello.
About the outflow and fiscal, for the standard SCEP and fixed limit
Yeah.
SCEP, they have the same offer.
Yeah.
In terms of the penalty or in terms of the amount.
Yep. What do you mean?
Like the outflow of the two SCEPs.
Yeah. So we set them up such that because we say recovery, because we basically set the fixed recovery to be equal to whatever the market implied floating recovery is. So at inception, when you start off, there's no upfront. Well, the upfronts cancel each other out, and the coupons are basically set to cancel each other out, and therefore these two things is basically the difference that we'll make.
Yeah, I understand this. So I mean, the notion of the fixed standard SDS and the standard SDS in this package is the same?
Yes. The notion was the same. Yeah, exactly. That's the point, that we effectively, we trade one CDS like a standard CDS, which let's say is a coupon of 100 and an upfront of 5%, and we trade another one which has a coupon of 100 and upfront of 5%. But in A, we're trading 1 minus recovery, which is floating, and in B, we're trading 1 minus recovery fixed, but we fix that to be the market implied floating recovery at day 1. And then through time, so effectively we've just got this because everything else has that, and then through time that thing kind of varies.
And they also have the same spread, CDS spread.
Yes, and that's how we do it. Yeah. Now, if we don't, in the contract, exactly. If we don't, then we have an upfront. Then it can be an upfront difference. So we kind of fix the coupons to be the same. Because the recoveries are implied to be the same, the upfronts are the same. And if the recoveries are different, then the upfronts will be different. So that will give you actually a P&L, which is essentially the P&L on the trade. So if the upfront is different, it means that you've kind of got an off-market recovery. It just gives you an upfront. No. Hello.
Question about the sell recovery, because here we say that if we sell the recovery, we need to make a payment if there is a credit event.
Yeah.
And the payment is equal to fixed minus an auction.
Yeah.
So here, if you think the recovery will be lower than the fixed level, then this amount should be positive.
If you think recovery will be lower than the fixed level, sell fixed recovery CDS. Yes.
So this payment should be made by us, not we receive some money from the company. Why so? Why do you say that?
So we're selling recovery,
Yeah.
so we want recovery to be low. Yeah. So we fix the level at it. So let's say we sell recovery at 40. If recovery is 20, we make a difference. We make fixed minus actual.
But these are the payments, like are the money we need to pay.
No, sorry. This is what this is. No. This means the payment that you receive on default.
The payment we receive, but like you sell, here you sell the protection, and when there is a credit event, you need to.
Yeah. So, but this is yes.
So you use 1 minus fixed.
So here you're buying protection, yeah, and here you are selling protection. Okay, so buying protection means that you're going to receive 1 minus recovery, and here you're going to pay 1 minus fixed recovery, right? So if you net those two out together, you're going to receive 1 minus recovery.
So you use this minus this, and you get this amount.
Correct. With a negative plus. Yeah?
Yeah.
So you pay 1 minus fixed recovery, which means that you receive recovery minus the floating recovery. There's a couple of negatives you need to cancel out there.
I think here the payments are what we are going to make. But
No, the payment
actually
is your the payment. You get a payment. So I mean, you get a payment of. But yeah, I hear you.
And question about
Yeah.
I don't know in practice, the CDS is using the actual divided by 360.
Yeah. Yeah.
And for bond is 365.
Yeah.
So from today to maturity is 365 days.
Yeah.
So for bond it's exactly 1 year.
Correct.
And for CDS it's 1 point.
Yeah.
So do we need to pay 0 points that spread for CDS?
You pay more. Yeah, you pay more than the coupon says. So if the coupon says, if the coupon's 100, pay quarterly, you'll actually pay 365 over 360 times.
Yeah. So that didn't match. So
What do you mean doesn't?
We know that the CDS and the bond has the same maturity.
Yeah.
If the convention are different,
No, it's just the amount. Not the date. The date is the same. It's the amount that's paid.
the amount that of the payment is different.
Yeah. So if you have a CDS 5% and a bond 5%, you will end up paying more on the CDS. Yes.
Okay, so that's okay.
Yeah. Hello.
We were just wondering, are there any more causeways coming up this
I think there might be one on the equity side. I think. I'm not positive.
It's not obvious.
I know. I think. Let me check for you, and we'll come back. I'm not sure. I'm not sure if he set one or not. Davide.
But it will probably be maximum one more?
It'll be maximum one more.
Okay.
Maximum one more. And if it is one, we'll make people.
Okay. Great, thank you.
So I only have one order for an article of behavioral and one goes with class. I only have like 3 or 4 courses. 3% is but that's including participation. So that's like this part of participation. So he says you get 100, but if you are but she's had to wear for because every I struggled with the whatever you're right. It's an accessible presentation, but it's all about learning immersion, like composure, like immersion, like, and there's a discussion. Discussion is 1 page. As a it's fair enough, like I was 10, but it's so short to present. Like this is the equation. No, it's all about no. Don't say oh, it has to like significant or economically significant, and it's all about. Yes, that one is like. Like not recession or bad security. It's the same. There's some types of people who they say that if you report that you are an owner and like you are not there and you actually are an investor, or the second situation is that you have a second loan collateralized in a house and you report you don't. And it's about how does that affect the portrait. It's horrible. It's because that person, I don't know how they, she said I'm quite chill on the paper. And one of the person that took that paper, I think she didn't put the paper. It's so and she didn't want econometrics, and it's all about econometrics. So I don't care. It's not a problem. I can present it, but it's so boring. I all. One of the most rigorous classes is so dry. It's so dry. But then, why not trust to Like an introduction for you, or said like just telling people something and then like nobody
Don't want the question.
Yeah, but if everyone is confused, then you know during your presentation. Was she there? You make it more fun.
Okay, why don't we kick off? So we're going to end off with iBox total return swaps, and then move on to Quanto CDS. So up until probably around 2012, 2013, the only really instrument that you had if you wanted to trade credit on a macro basis was the iTraxx CDS indices. Okay, you didn't really have a macro instrument other than that in order to trade like a portfolio of credit. So back in 2012, we basically introduced total return swaps on the iBox corporate bond indices. Okay, so the iBox corporate bond indices are essentially a family of indices that they basically take, they have selection criteria and they look at all of the bonds that are eligible for selection, and then they basically calculate the daily change in all of those bonds and they aggregate that up into a daily change for the index. So effectively what it's kind of saying is that if you bought all of the bonds out there that met the eligibility criteria, this would be your P&L over a given period of time. Okay, so effectively what you've got is you've got a rates component there, you've got a credit component there, you've got the coupon carry there, but essentially the index is just a kind of representation of if I bought everything in the universe, what would it be? And typically these are kind of instruments that are not traded, but they are used as benchmarks. So they're basically just like a theoretical calculation of a benchmark, which is effectively like all of the bonds that meet the criteria. So you could have like a European investment grade iBox corporate bond index. The return of that will tell you what the overall index return. So kind of like if you had like the FTSE and you owned the FTSE and you just had an index that kind of tracked the return of all of the equities in the FTSE or any bond index for that matter, you could basically kind of get an index which starts at 100 and then on a daily basis just goes up and down, theoretically as if you'd held all of the bonds that were in there. Now, because bonds mature, because they change ratings, there's typically a monthly rebalancing where essentially they kick out all of the bonds that are no longer eligible because they've been downgraded, because they've got too short a time to maturity, because they don't have enough notional outstanding, and then they add in all of the new issues that have kind of come. But this is kind of the benchmark. And if you're a portfolio manager, you tend to kind of measure yourself against the benchmark, which is essentially to say you kind of measure yourself against how the average market is performing. So what we decided to do back in 2012 is essentially to have a total return swap, whereas essentially we would have a contract which just paid you the return of this index. So although it's kind of a theoretical return, we can basically create a contract which basically says we will pay you whatever the index level, whatever the index return. So for example, if the index level was 211 at the end of 2015, and then at the end of 2016 it was 221, your return would just be the percentage return, so the ratio of those minus 1, multiplied by whatever notional you wanted to trade. So this is kind of how the benchmarks came in. And then I think the important thing to know is you have a benchmark, which is just an underlying index which goes kind of up and down. And then on top of that, you overlay a total return swap. So the total return swap basically says, I will pay you the return of the index. So one counterparty is basically paying final level minus entry level divided by entry level, so the percentage return. And the other counterparty in exchange for that is basically paying them 3-month Euribor. So that's just kind of like fixed. So you can kind of think of it as like a way of funding a bond portfolio. Okay, you pay Euribor. Imagine you were able to borrow at Euribor and buy all of the bonds. Effectively, that's kind of what's happening over here, but we're just doing it in a sort of swap format. So you will pay me Euribor, and I will pay you the return of this particular index. Now, the reason why there is a Euribor leg over here is because the bonds themselves have a rates component to them. They are what we say funded. There is if you were to buy them, you would actually have to borrow money in order to buy them. Unlike a CDS contract, where in order to go long risk, you don't actually have to buy anything, you don't have to pay out anything, you just have to sort of sell protection. There's no cash outlay in order to go long. Whereas bonds, you have to actually pay for them, so the kind of one counterparty pays Euribor, and the other counterparty in exchange for that will basically pay the total return, the difference in the index level. And remember, that index level is based on something else. That something else goes up and down by the daily return of the underlying bonds. So it's a good way to kind of gain market exposure. Okay, so what do we trade total return swaps on? We trade them on basically the kind of family of global indices. So IPOX Eurocorps, high yield, liquid investment grade, dollar high yield, leveraged loans, sterling corporates, and actually recently they've kind of started to do them on like the 10-year bonds as well. So any bond, in the 10-year index, so any bond that is above 10 years is eligible for the index, and you can basically trade a total return swap on that. So essentially, you basically trade a total return swap on whatever index you want to trade on. You define the criteria, the underlying bonds go up and down, they create a return, and you basically have a contract where you pay me the total return and I pay you Euribor in exchange. So as an example, suppose you want to go long the Euro high yield index, or you want to go long European high yield. Okay? How can you go long European high yield? You can go and borrow, you can go and buy bonds. You can go and sell crossover protection, or you can go long. You go long through an ETF, or you can go long through a TRS, through a total return swap. So let's say you want to go long through the TRS. What have we got here? It's a 50 million trade. You've got a 3-month TRS. You enter at 160. So the underlying level says it's at 160 when you enter. You pay Euribor, which is 25 cents. And on the 20th of June, so kind of 3 months later, the index has basically gone from 160 to 163. So your P&L is just the ratio, 163 divided by 160 times 50. or -1 times 50. So that gives you a P&L of, as we can see over here, kind of 940k. And then don't forget, you have to pay the floating leg of the contract. So you have to pay 0.25, so 25 cents, times 3 months, because that's an annual amount, so we kind of are doing it for 3 months, so it's 1/4 times by your notional. So net you've kind of made 906k from this particular trade. And the important thing as well is you don't have to lay out any money. You don't have to like borrow 150 million to go long the high yield market, because effectively that kind of funding is kind of put into the contract through this floating leg of Euribor that you are paying over there. The other thing about this is, as you can see, like we've done it from the long perspective, but if you want to go short, then you kind of just reverse it. So it's a very easy way to go short the market. If you wanted to go short the high yield market, yes, you could go and buy crossover protection. But if you wanted to go short cash bonds, it'd be quite difficult. You have to go out and kind of repo all of those bonds. Whereas if you do it through a TRS structure, effectively you just say to someone, I'm going to pay you the return. If it's positive, you make money. If it's negative, I make money. And you are going to pay me the floating leg of whatever that contract is going to be. So here's kind of a typical run that you will see. This was from kind of earlier last year. But essentially, as you can see, you've got kind of the NAV of the underlying index. So that's essentially where the administrator who is marking those those bonds effectively. So that's currently at 185. The interesting thing is that what you tend to see is that market actually kind of the administrator does it on a daily basis, so they do it at the end of the day. But if you're trading the next day in the middle of the day, things have kind of moved around. So that's why we've got kind of last end of day NAV on the right hand side of that run, and then the live estimated NAV on the left hand side, which is kind of where the market maker thinks that things have moved based on where prices in the underlying are kind of going, based on where rates might be going, based on a bunch of kind of other things. You then got kind of an indicative yield, duration and spread for the portfolio, and then you've basically got kind of your TRS expiries over here, and then you've got your bid-ask level over there as well. So for example, if you wanted to go long the 20th of June 2018 contract, you would get in at 185.04. You would then see what happened to the index level over the subsequent however many months it was. If you wanted to go short, you would go short at 183.04 as well. And again, the P&L, it's relatively simple. It's just going to be the ratio of what the final level was on the expiration date multiplied by your notional, and that basically tells you how much you made or lost from this. So it's kind of like a nice, easy way for investors to gain market exposure through a very broad based index. Who kind of uses it? Real money. So some of the very early users of the product actually tended to be investors outside of the credit market. So if you were a rates investor and you decided, I'd like to get a bit more yield, I'd like to go long corporate bonds, but I don't want to go out and manage and buy a whole lot of corporate bonds and worry about that. I want to kind of tactically go long for the next 6 months. The total return swap is a nice way to have a kind of tactical long allocation. You enter the index or you enter the swap, you basically get the return and you pay out your LIBOR leg on the other side. If you've got inflows into a fund, let's say you're a corporate bond fund, you've had an allocation of 100 million, there's no new issues, you don't know which bonds you kind of feel like buying, you're still doing a little bit of work. Go along the TRS, you kind of get the market return for the period that you've got the swap on, and then you can kind of buy bonds over that period, because don't forget, you've still kind of got the cash on the sideline, and you can unwind the TRS through time as well. On the fast money side, a lot of our hedge fund accounts kind of use this as a hedging instrument. If you want to kind of if you think, yields on European corporate bonds are at all-time low, not only are spreads at all-time low, but rates are virtually negative, in many instruments at the moment. Going short through the TRS is a much easier way to go short the market than having to go out and repo all of the bonds. Now, yes, you could buy crossover protection. That's another means of going short. But if you buy crossover protection, you don't have the rates component. So if you want to have both the rates component and the credit component and also be exposed to corporate bonds, going short through the TRS is a nice way to do that. This slide just sort of shows some of the kind of pros and cons of the different instruments that you can use there. ETFs are an alternative. The thing about ETFs is ETFs are probably most commonly compared to total return swaps. One of the issues with ETFs is you have a tracking error, which you don't have with a total return swap. Total return swap basically gives you the return of the benchmark. It gives you whatever the benchmark is going to be without this kind of up and down tracking error. The tracking error in ETFs relates to the bonds that the ETF owns relative to the benchmark that they are trying to track, but also relates to the kind of price of the ETF relative to the bonds that they own themselves. The other thing, if you go through CDS, as you can see, back in kind of 2008, 2009, there was a big basis. I think Moritz spoke about it in the basis lecture. A big basis opened up between bonds and CDS. So if you had been hedging with CDS, you actually had a pretty negative return, whereas if you'd been hedging with the total return swap, because it reflects the underlying bonds, your tracking error was actually significantly better in that scenario. This slide just kind of goes through, kind of a bit of tracking error, basically to show that, if you use a TRS, it can often be a lot better. I think one thing that's probably worth highlighting that I don't really think I kind of spoke about is that in the trade, the contract basically says one counterparty pays the return of the index, and the other counterparty pays LIBOR, okay, for 3-month LIBOR. So how do we trade the instrument such that if we think there is like demand for bonds, or we think that the funding of these bonds should be more expensive than just paying LIBOR? And effectively, that's what happens in this mid-market or the entry level that you get in at. So as you can see, the entry level for the June 17 contract is higher than the entry level, let's say, for the September 17 contract. So effectively, the dealer kind of skews the level that you get into the contract at to reflect the demand or supply of people wanting to go long or short through the TRS. So if all of a sudden there's a whole lot of interest in going long through the TRS, because the contract always says you pay your LIBOR and you basically get the return at the end date, effectively what you're going to do is you're going to say, well, everyone wants to kind of go long at the moment, so we're going to sort of skew the price up relative to where the end of day NAV was yesterday. So in order to kind of go long, you basically have to pay more. You have to pay a price above the NAV, which effectively means that you're kind of getting in at a higher level, which effectively means that you're kind of funding this portfolio at a more expensive rate. So the way that this kind of trades is that the mid-market and the bid-ask kind of move up and down relative to the NAV in order to kind of encourage or discourage people from taking positions going one way or the other. So kind of, it's similar to a bond. The price itself moves around, but you kind of look at the price relative to the NAV to see whether investors are going long or going short. If the price is above NAV, then people are interested in going long. If the price is below NAV, which is kind of what we're seeing at the moment, then actually investors are kind of using it as a hedging product. So that's total return swaps. Not a lot to say on them. They are relatively kind of easy and straightforward contracts. And I guess the last thing that we will end off with is Quanto CDS. So, so far we have looked at CDS contracts in kind of a single currency which is typically like your home currency. So if you're a European corporate, you have Euro CDS. If you're a dollar corporate, you have dollar CDS. But what happens if you want to trade European sovereigns or European corporates in dollars or in a different currency? Is there a price for a CDS contract in a different currency, and how should we think about whether that price is different from the contract in a domestic currency? So maybe the kind of, at first blush you might say, look, if I'm buying protection in euros or I'm buying protection in dollars, it shouldn't actually make a difference. Okay? If you buy protection in euros, your recovery rate is still 1 minus recovery. Okay? If you buy protection in dollars, your recovery rate is still 1 minus recovery. It's not recovery dollars, recovery dollar bonds or euro bonds, because you can deliver either dollar bonds or euro bonds into the contract. They're both deliverable currencies. But what you're looking for is 1 minus recovery. But the difference is 1 minus recovery in euros or 1 minus recovery in dollars, i.e. the actual cash amount can be a euro amount or a dollar amount. And that's determined by the currency of your CDS contract. So the 1 minus R is the same, it's just whether that 1 minus R is a dollar amount or whether that 1 minus R is a euro amount. So at first blush you might think, well, it doesn't matter. Like, whether I get 1 minus R dollars or 1 minus R euros, as long as I kind of trade the right currency amount, it's not going to make any difference whichever currency I use. However, if you think about a case like Germany, okay? If Germany is having a credit event, what would you rather own? A currency that's paying you, or a CDS contract that's paying you euros, or a CDS contract that's paying you dollars? Dollars. Why would you rather own dollars? Because the expectation is that the currency is going to depreciate when Germany is defaulting. Okay? So your payout in euros is going to be much less than your payout in dollars. So kind of intuitively, you should pay more for the dollar contract than you would be willing to pay for the euro contract. So that kind of gets us thinking about, how do we think about that? And, it's primarily on the sovereign side. But this is kind of what we talk about when we talk about kind of quanto markets. We've given a bunch of examples over here. But, let's say Italy, which is a common one in the quanto market, in dollars you pay 113 basis points. If you were to buy euro protection, it's only kind of 86 basis points. Okay, so the quanto is basically about 30% more in euros versus dollars. For something like Germany, I mean, it's almost double the spread. In dollars you're paying 21 basis points. In euros you're paying 10 basis points. So kind of like the more, I guess, Portugal over there, the difference is only like 17%. Why? Because it's like less systemic. People kind of imagine that if you're buying protection on a country that's sort of less systemic, the likelihood of the currency depreciating a lot one way or the other is going to be much, much less. So Portugal, probably like the least systemic of these, the quanto is not very much. If you look at a corporate, a standard corporate, the quanto is actually going to be quite small, because if, BT defaults, whether it's in euros or dollars, doesn't really matter all that much. They're not going to have any currency impact. It's only once you start to get to kind of more systemic companies that you start to get a bigger issue. So that's one thing. So when we look at pricing CDS in different currencies, we actually kind of take into account, I mean, there's different ways to do it, but I think what we're kind of trying to build here is a bit of like an intuitive way about doing it. But the way that we've looked at doing it over here is to say that there's kind of two components, okay? Component one is this like depreciation on default, and that's sort of what we've spoken about so far, okay? If X defaults, what is the depreciation in one currency versus another currency? Okay? The second thing which we can kind of look at is not even thinking about default, but just thinking about correlation. Okay? So if I tell you that when markets are risk off, i.e. when spreads are widening, the dollar tends to appreciate. Okay, so there's a positive correlation between risk off, spreads widening, and the dollar appreciating. Which currency would you rather own CDS protection in? Euros or dollars? Dollars, right? Because you're actually going to make more. Even though there's no default scenario, if the dollar appreciates when spreads widen, you make more in dollars. And also when the dollar, and also when you have a risk on scenario and spreads tighten, so you lose money. If the dollar depreciates in that scenario as well, you actually kind of lose less relative to euros. So you're kind of making more when dollar's appreciating, and you're losing less when dollar is depreciating. So this is what we kind of call like slippage, and it's kind of due to, as we will see, the sort of correlation between spreads or changes in spreads and FX. So how do we kind of think about the sort of depreciation on default? We'll deal with these two things separately. So depreciation on default is relatively kind of straightforward. Basically, it's going to just impact your kind of recovery rate. So what are we sort of saying? That if we have a CDS contract, if we have a CDS contract, what is the in dollars relative to euros? What is the additional amount that what's the additional loss that we would gain, or the kind of additional amount that we would expect to make or lose due to the depreciation, is basically just going to be 1 minus the 1 minus recovery, so kind of like our contingent leg. So what is the value of the contingent leg? 1 minus recovery multiplied by the depreciation. So prior to the credit event actually happening, it's basically just going to be the depreciation that we get from this event multiplied by the probability of actually kind of making that. So effectively, it's kind of the depreciation times the spread times your risky annuity is basically going to give you your kind of value due to the depreciation on default. Okay, so that's kind of like the first part. So that's sort of the first part of it, and we kind of get this, depreciation on default times spreads times risky annuity. So the example that we've given here, if you expect something to depreciate by 5%, and your par spread is 200 basis points, risky annuity of 4.5. Then basically your depreciation on default is going to give you an extra 0.45% on your trade. So that's kind of like the additional value. It's currently, you can kind of think about it in a sort of fixed recovery sense that we were kind of thinking about before. If you've got a contract which you expect to pay you 5% more, how much would you pay for it? Well, you'd kind of pay 5% more in terms of spread. So spreads should sort of change by a similar amount to the kind of payoff that you're expecting over there. The second thing is a little bit kind of more involved, and how do we kind of account for this depreciation on default? So the way to kind of think about it, I guess, is to think about what is your daily P&L in a CDS contract. So your P&L on a daily basis is going to be equal to the change in spread, okay, multiplied by your risky annuity. So that's your kind of P&L. Okay, so it's like standard CDS contract, change in spread times risky annuity is equal to your P&L. But now we've basically got a contract which is in dollars, so we're going to have to basically multiply that by the change in the currency. So fx0 is currency on day 0, fx1 is currency at the end of it. So effectively, our change in spread times our risky annuity times the sort of change in the currency that we're going to have over there. So how can we kind of start to rearrange this? Well, we can basically say that sort of, our change in our fx is equal to, fx on day 0 divided by the and essentially it's kind of like, the initial fx times 1 plus the change in the fx, okay? And then if we start to sort of rearrange things, we basically get that that is going to be equal to, if we take off sort of higher terms, 1 minus the change in the fx in percentage terms. Okay? So basically, you can kind of approximate your fx change by 1 minus whatever the fx change is going to be. So that's kind of our starting point. Okay, so we've got P&L, and we've got this is our daily P&L, right? This is on a daily basis. What is it? Okay. So what we're trying to get to is like our P&L, our expected P&L over the life. So we're going to start with it on a daily basis, and then we're going to kind of sum it up and see it over the full period that we're holding it for. So that's our kind of daily P&L. So the question is what is our kind of expected daily P&L? So our expected P&L is then basically just going to be our expected change in spread multiplied by the risky annuity multiplied by 1 minus the change in the fx, or the percentage change in the fx, which we have over there. And then if we can kind of say, well, it's a little bit of an assumption, but it's not too bad, which is essentially to say that the risky annuity is kind of independent of the change in spread. Then we can basically take our risky annuity out of that equation over there. So we're basically going to be saying that it's equal to the expected risky annuity multiplied by the expected change in spread multiplied by 1 minus the change in the fx. Okay, so this is kind of what our kind of, again, this is just on a daily basis. What are we expecting our P&L to be on a daily basis? There. Okay, so now we can kind of go back to some of our sort of A-level mathematics, shall we say? And we basically say that the expectation of the product of two variables is equal to the covariance of x and y plus the expectation of x multiplied by the expectation of y. Right? So if we then basically apply this identity to this guy over here, and if we kind of like expand out the brackets, we're going to get the expectation of the change in spread minus the expectation of the product of those two. We're basically going to get that we're going to get that our expected P and L is equal to the expected risky annuity multiplied by the expected change in spread. So that's from there minus the covariance of the change in spread and the change in fx, minus the here, minus the expected change in spread times the expected change in the fx. And I think this is a plus over there. So all we're basically doing is kind of using this identity, sort of expanding it out over here, and we're basically going to get that our expected P&L is going to be our expected risk annuity times the, sorry, let me put minus there, that was there, yeah. Our expected change in spread minus the covariance plus the product of the two. Now the next thing that we're basically going to kind of say is that because it's kind of like, normally distributed spread moves, our expected change in spread on a daily basis is zero. Okay, the spreads are kind of like bouncing around zero. Okay, so sometimes they're up, sometimes they're down, but our expected change in spread is basically going to be zero. We're also going to say that kind of the product of these two are sort of small because we're talking about kind of daily spread moves. So this and this are basically going to get kind of crossed out over there, and essentially what we're going to be left with is that our expected P&L on a daily basis is just going to be equal to our expected risk annuity times the covariance of the change in spread and the change in the FX rate over there, which is essentially what we've kind of written, there we go, at the bottom over there, so that we can then take this minus out and whack it in over there. Okay, so on a daily basis, it's basically going to be kind of the covariance, how these two things vary with each other, multiplied by our expected risky annuity on any given day. So this is kind of like on any given day, what is our, like, what should we expect our P&L to be? Okay. So the next thing that we are going to say is we're going to kind of expand out this covariance term over here. So we're basically going to say that the covariance of x and y is equal to the volatility of x times by the volatility of y multiplied by the correlation between the two of those. As that's basically what your covariance is. How much do these two things vary relative to each other multiplied by their correlation. So again, if we take this and apply it to our expected P&L over here, we're essentially going to say that the expected P&L, and remember again, this is also talking about our daily P&L, is equal to the expected risky annuity multiplied by the covariance, which is the vol of x times, the volatility of the change in spread, volatility of the change in the fx, multiplied by the correlation of change in spread and the change in fx. So kind of the correlation between those two things over there. So what is the volatility of the change in spread? Well, that's basically, we can sort of say that this thing over here is equal to spread, because this is in basis, like this is kind of like a basis point amount, okay? So it's going to be spread times the volatility in percentage terms divided by the square root of 252. So this thing here is now kind of the annual volatility, okay? So we've kind of moved from a daily volatility to an annual volatility. So because we've moved to an annual volatility, in order to kind of have it as a daily amount, this is daily, this is annual, we have to divide by the square root of time by the square root of 252. And similarly, we're basically going to say that this guy over here, this daily change in the fx, is equal to our annual volatility in percentage terms divided by the square root of 252. So again, that bit over there is basically just about getting from sort of daily volatility or from annual, from daily vol into an annual vol number. Because so far we've kind of talked about the daily vol, and we want to sort of have it in, what's the annualized volatility for all of these things. So if we then kind of plug these back into our equation as we've got at the top over there, I think I'm missing a minus here, sorry. If we plug them back into our equation as we have it at the top over there, we're basically going to get that our expected P&L is equal to our expected risk annuity multiplied by our annual vol of spreads in percentage terms multiplied by our annual vol of fx, fx in percentage terms multiplied by the correlation multiplied by 1 over 252. So essentially just kind of like plugging these two identities into that equation over there. And remember that this here and this here are basically now in annual terms. Okay? So we've basically been able to sort of express our daily volatility as essentially a function of the risk annuity, the annual volatility of spreads, the annual volatility of fx, the correlation between them, and some kind of number of days effectively between the two of them over there. So then the next step that we're basically going to say is, so far we've spoken about this on a daily basis. Okay, so everything that we've done is basically about looking at, what is our daily P&L, but actually what we want is, we want to know what is our expected P&L from this slippage, from this kind of contract over the life. So our expected slippage is going to then be equal to the sum of our expected daily P&L, which is then going to be equal to, if we take everything kind of out of the brackets, is going to be minus correlation, the spread vol times the fx vol. These are both annualized percentage amounts multiplied by 1 over 252 multiplied by the sum of our risky annuities over essentially the number of days that we have the contract outstanding for. So that's kind of the life of the contract. So our slippage, again, what is the P&L from this kind of correlation between spreads and FX? That's sort of what this is going to be, is now just some function of correlation, volatilities, and our risky annuity over there. So the thing that we kind of need to do, sorry, there's an expectation here, pardon me. So the thing that we're going to need to do is kind of calculate what this sort of expectation is going to be. We're not going to kind of go through it, but basically you can kind of show that your expected sum of the risky annuities is approximately equal to the risky annuities squared over over 200 and over 2, yes. Is equal to your risk annuity squared over 2, sorry, multiplied by 252. So yeah, your risky, you can kind of, your risky annuity function looks something like that, and then when you kind of, again, if you sum all of this area up over here, you can see you're going to get something that's sort of parabolic as such in nature. So if we then take our expected sum of our risky annuities, which we've said have approximated to this, plug it into our equation over there, and ultimately we kind of end up with our sort of slippage is being equal to correlation multiplied by vol of spread multiplied by vol of fx. This gets cancelled with that, and we get multiplied by the risky annuity squared divided by 2. Okay, that's kind of where we sort of end up. And then if we flip back to our depreciation on default, which is kind of the other part of our equation, we can basically say that the additional value from buying this contract in dollars versus euros is going to be equal to the additional value is going to be the difference in spreads. So let's say spread dollar minus the spread on the euro contract multiplied by the risky annuity. Okay, so that's kind of the overall value, and that's going to be equal to our as we have earlier, we had the FX depreciation times spread times risky annuity. FX depreciation times spread times annuity minus or plus the slippage, and the slippage is a negative, so we're going to say minus the correlation times the vol of the spreads times the vol of the FX times our risky annuity squared divided by 2. So we can now go and do some kind of cancelling out. So we can get rid of our risky annuity there. We can get rid of our squared risky annuity. Get rid of our risky annuity there. And we can then divide everything through by, excuse me, the kind of euro spread, let's say. So divide everything here by S euro. That's going to get rid of that one over there, and that's going to put a and that's going to put a 1 over our spreads in euros over there. And now we can basically rearrange that a little bit more by essentially we can do better. Oh, where was that? Where we finished? So essentially we're saying that the spread in dollars minus the spread in euros divided by the spread in euros is going to be equal to our FX depreciation minus our correlation multiplied by our spread percentages, annual percentage, times by our FX spread times FX times risky annuity over 2. Oh, sorry, I've missed out a. There should have been an S in here. So sorry, so this one gets rid of that as well. So essentially we get left with the kind of, change in spread in percentage terms is going to be our FX depreciation minus some correlation between those two, between the vol of spreads and the vol of the FX multiplied by our risk annuity over 2. So ultimately what we're kind of getting to at the end of this is that we can express the quanto, so we can express the value of this contract, i.e. the value of how much you should pay for a contract in euros versus dollars as a kind of percentage in terms of how much we expect to make from our depreciation, minus some correlation between, if they're positively or negatively correlated, between our volatilities normalized essentially by the sort of risky annuity of those contracts. So the more correlated these two things are, the higher this is going to be, which means that the higher we need to pay for our depreciation kind of for the dollar contract that we have in this case. Similarly, the higher that this thing is going to be, the more depreciation we get if we do have a credit event, the higher we're going to have to pay for our CDS contracts as well. So ultimately, if you have more volatility, so I suppose the other thing you can kind of think about is, if you have a spread and an FX where the two are not correlated with each other, so if your correlation actually ends up being 0, then essentially this thing is going to be 0, and you're likely not to see very much over there as well. On the other hand, the typical case is that appreciation or risk off spreads widening tends to be associated with FX going down. So effectively you're going to have like a negative correlation over here. So the more negative the correlation, the more you're going to have to pay for a contract in dollars relative to your contract in euros. Historically, we've shown here some of the quantos for France, Spain, and Portugal. As you can see, the kind of Portuguese quanto is relatively low. kind of ranges between sort of 10 to 15 to 20%. The Quanto for Greece, Quanto for Spain is higher, it's more systemic. And then the Quanto for France, again, kind of the most systemic of the three of those, because effectively the kind of negative correlation is highest between those, as well as the kind of depreciation on default is going to be sort of the greatest. You're going to get kind of the highest Quanto measure when you compare spreads in one currency versus the other. But I think ultimately, the thing to remember about Quanto is, kind of going back to what we spoke about at the beginning. If you have a euro contract and you have a dollar contract, which one would you pay more for? You basically would pay more for the one where you got a bigger payout, either because there was a default or because there was kind of more of a negative correlation between the currency itself and the spreads of that instrument. I think that's it done. There's a couple of additional materials that you have on your on the website, and that's it from me. Thank you very much to everyone. You will have Davide for the next 3 classes, and then Moritz coming back at the end. But for me, I hope you've enjoyed it, and thank you. Hi.
I will start from here. From here, the covariance is the change of the spread and change of the x.
Yep.
But at the end, it becomes
It is a change. Yeah. When we talk about the volatility of spread, it's the change of the spread. Yeah. Exactly. So that's the annual spread volatility. But so it's basically
there's no y here, so it's here.
Yeah, exactly. So it's the annual percentage spread volatility, which you basically calculate as the daily or the percentage change in that.
A couple of questions.
Yeah.
The first one is why here you add an as?
Because this is sorry, I said it and then I forgot about it. This is a basis point change. Okay. This is a percentage change.
So you need to
multiply it by your spread level. If I tell you that the spread has changed by 5%, how much is that in basis points? But in base, you don't 5%. I'm saying it's 5% of spread. But you only know that if you know what the spread is. So I have to tell you the spread is 200. So 5% of 200 is going to give you 10 basis points. So that's what. So 10 basis points is equal to spread 200 times by the change in spread. So it's a change of. It's a change in spread, not a change absolute.
And how can we tell which currency is the standard currency and the other is the
Normally it's normally if you have a dollar contract, it's a dollar.
It's a standard.
It's a dollar CPS. Yeah. If you have euro contracts, like euro companies, it's a euro CPS.
Okay, so
it's normally like the country or jurisdiction. Basically, European stuff is euros. Pretty much everything else is dollars.
So here, why say that if the correlation is negative, then this will result in non-standard currency trade with a higher expected loss. Because I think this expression is the expected profits and loss for non-standard currency, right?
Yeah, I mean, I can't remember exactly, but if you work through it, it kind of makes sense if you go. if you come here, like because current depends on how currencies are quoted. So when you look at like euro dollar, if euro dollar goes from like 1 to 105, that actually means that the dollar is depreciated.
Yeah.
Okay, so if you're doing it here, that would be like, that would be 105. So effectively, your dollar would be, even though that has gone up, your FX rate has gone down at that point. So similarly, when it goes from 1 to 95, your dollar has actually appreciated there. So that's why like a positive change is actually a depreciation. When the dollar goes from 100 to 105, positive change, but it's actually a depreciation. It's actually a loss on the non-standard contract. You just have to get your head around that sometimes. When you go through it, it makes sense, but it is a bit confusing sometimes because of the way that currencies are quoted.
Yes. Okay. Thank you.
Okay?
Yeah, I'll go.
So an increase in the FX rate is actually a depreciation.
Yeah.
So there's actually a loss for the dollar contract. So it's going up, but actually, similarly, when the FX rate goes down, so when the change is negative, it's actually a positive for the dollar contract.
Okay, so if like in a dollar CDS, dollar is the standard currency. So when you quote the exchange rate.
Well, no, the exchange rate is just quoted as it's quoted. I mean, there's just like standards about how it's quoted. But this, what we've done here is typically what we've looked at it here is from like the euro perspective. From a euro investor perspective, so euro versus dollar.
Euro versus dollar, and the standard currency is the euro.
Yeah, and that stuff. It's euro. Exactly.
Okay. Thank you.
Hello.
Sorry, I actually got a question on the slides,
Okay.
but on your group.
Yeah.
I couldn't really find your profile on LinkedIn. Which specific groups are you?
I work in my team is the credit derivatives and strategy team.
Right.
We cover basically European credit strategy, which is kind of market strategy,
Right.
and derivatives and
What is
all of the
this?
good stuff.
Okay, what does the stress do in JP Morgan? Does it mainly make stress provide desk supports to traders, or it actually has P&Ls?
Sorry, say that again. What is
The stress team does actually in JP Morgan.
Oh, my team is part of research.
Right.
So we are basically providing research for clients.
Okay.
So clients of the bank.
Right.
And also the trading desk itself. So it's kind of it's a mixture between like internal trading and stuff like that, and external clients who are clients of the bank.
Right.
So it's kind of like mixed. Yeah. So things like this. Yeah. A lot of the stuff that we do is training, not as much detail over here.
Right.
Sometimes we'll do things like this for kind of clients.
Okay. Is it a part of quantitative institute of JP Morgan, or?
No, it's sort of more of a market-facing role. So the quant stuff is a bit less market-facing. The quant stuff tends to be more model sort of driven. So it's basically part of research.
Okay.
It's basically part of research.
Okay.
Yeah.
That's pretty much all my questions.
Good.
Thank you.
No worries.
居然现在才下课，好累，好累啊！觉得委屈爸爸，我也委屈爸爸。耳朵还疼，觉得自己更委屈了，觉得自己超可怜，在风中飘荡，弱小又无助。我觉得我讲道理不能再熬了，我再熬夜的话，我已经被今天的反应速度惊呆了。上面要不然就在睡觉，没睡的时候呢，反应速度就慢的要命，看一句话看半天还理解不了它什么意思，一个词一个词读过去，结果一个字都没有记住。
我觉得我现在真的会变得很小哎，我觉得我有可能我不会有厌食的人，应该不是，可能是因为这两天房价也上去了。
你想买房大吗？
没有，我觉得因为我特别早，我已经好几天，我已经好几天一天吃2顿饭，
那不够，
对，还不够。
我分你杯咖啡，真的我分你给你吧。
要不你试试看下午帮我带杯咖啡吧，可能到晚上就没吃了。我带了一个便当，一般都没吃。
你带什么？
就是那个西兰花加鸡